So let's continue along and use the data set we have been working with. Remember, we started with the data set where you had 49 years of asset class returns data. So we're going to run through this code and create uh, that portfolio combination and calculate all the means and variances, and then we will extract a column. Don't worry about the code part yet. You will be able to do that later on once the course is. I just wanted to sort of demonstrate, So this calculates the mean column, okay. And let's look at what that looks like, okay. Actually, let's look at both, okay. And DFP, okay. So you have the mean column, okay. These are all different portfolio combinations, see that, okay. And you have the mean column. See, this is 100% in one asset class 1 and 0% in the remaining, right? And it has a mean, it has variance, it has standard deviation. You see that different combinations of portfolio have different values for the mean and standard deviation, which is what we are after, right? So all this stuff we have done is basically to get to a point where we can sort of run through different portfolio combinations to come up with these two values, okay. And we do that for 7,658 portfolios. Imagine how quickly we did that, right? So imagine doing that by running through loops, and that's the power of matrix algebra, right? So it was a pretty quick operation to do that, okay. And this is the plot we are looking at, or we are after, right? And you see that you remember we talked about that efficient frontier, right? You see that frontier forming right here, right, where you have all the optimal portfolios lying on this frontier. Anything which is below that are suboptimal, right? So of course we'll start out with the worst portfolio in this is this one, right? It's lying all the way out here on the risk spectrum, but it's not giving you as much return. It might look a pretty decent return, like 10% a year, but it comes with a lot of volatility, which actually has an impact on the return, which we actually have seen, right? So portfolio 7658 is the highest risk portfolio, okay. And as expected, it's invested in 100% commodities, because that was the asset class with the most amount of volatility, okay. And it's not optimal because it's nowhere close to the efficient frontier. 920 is the lowest risk portfolio, and it owns 10% bonds and 90% cash, which is expected, right? So you have the least amount of volatility but not as much return, right? 2823 delivers the highest average return, which is here, and it's comprised entirely of REITs, which we have seen from the data. The REITs have done the best, right, which is expected. And then there are this couple of other portfolios we're going to look at, right? It's invested in 20% large US equity, 30% in bonds, 40% REITs, 10% to commodities. And this one is 4755, which also lies on the efficient frontier, as well, with 15% volatility. Its allocation is 20% large US, 70% REITs, etc. So what we are seeing here is that though the portfolio actually in hindsight did very well, they don't look that healthy, right? So first of all, you would not want to do this today, right, in today's interest rate, because I'm not sure how many of you have bank accounts, but if you do have a bank account and if you put money in the bank, you know how much return you're getting, right? So that doesn't make sense. This one definitely doesn't make sense. Now, are you willing to stake? Okay, this is what you're going to invest for 50. This is 49 years data, right? So let's run through that, okay, just to sort of understand what I'm talking about. Okay, this is looking at the dollar value of this individual portfolio, right? As you can see, portfolio 920, which was heavily in cash and bonds, is not as volatile, but it doesn't grow as much also. The inefficient portfolio is 7658. It doesn't get you as much money. in the long run, but it's highly volatile. So what is the point, right? And of course, the REITs are the best. Where is the REIT one? I think the REIT is 2823. Let's look at 2823. Yes. So this is the one which is in REITs, right? But you don't have to actually look at the REIT. This 4755. Okay, which one is the next best portfolio after REITs, right? Is that orange 4755? Okay. So I would say if I had a choice between REITs and 4755, which is 20% to large cap, 70% REITs, 10% to commodities, okay, I would probably pick that, right? Because it at least has a little bit of diversity, right, in terms of having different types of investments. But even then, that 70% allocation to REIT doesn't look a lot healthy, very healthy, right? I would say the healthiest portfolio in here is this one, right? Because it has different flavors of different types of stuff, right? But again, this is not ideal as well. So what I'm going to tell you is, okay, and that's probably would have yielded like half the amount of money, right? So what I was trying to tell you is that this is doing all these things. You might actually say that, oh, we did all this math for nothing, right? We couldn't even get to a point where you can give some sort of a formulaic approach to making a lot of money, right? If it were that easy, right? Because this entire premise is based on historical data, okay, and we can do all the math we want with historical data, but what we want is what does it look like moving ahead, right? And I'm sure you would have come across this term where whenever you open a prospectus for a financial investment, as a past performance is not a guarantee of future results, and that also is what we're trying to say here, right? So we have got this one shot to go from point A to point B, assuming you start working at say 2022, right? And you continue working till you retire. Let's say the retirement is like say 49 years away, right? That's a very long work life, but let's assume you do that. You're not going to be banking on like this one type of investment, right? What if so you don't have the ability to make this kind of bets, right? Plus whatever happened in the past is unlikely to be repeated again, okay? At least not in the same way, and that makes sense, right? Because if you just look at, okay, just go back in time like 100 years or 120 years, right? I think one of the data set I was looking at is the size of the stock market or the value of the stock market by country, right? And I think in those days, I think England or Great Britain had a much larger value of the stock market than United States. The United States was like probably in low double digit or even in single digit market value, right? Because US at that time was like a developing country. It was still forming. A lot of the institutions, a lot of the structure was being formed, and so, right? So nobody would have sort of anticipated that US, or at least some people did, but it was not a short thing where a country would sort of evolve and come to dominate not only the globe in terms of the wealth of a nation, but also from the perspective of dominating in terms of what percentage of the global stock market does the United States occupy, and at last count it is around 55%, right? So it went from like single digits to like 55%, right? So people couldn't anticipate it, and you don't know what the future is going to look like, so you cannot bet, and that's why you want to have a little bit of sensible diversification, okay? So let me give you just one example as to why what has happened in the past is unlikely to be repeated again. Let's take the interest rates, okay, and the value of bonds. When you have when interest rates go down, the bond prices go up, and we know that why, right? Because if interest rates go down, okay, uh, the bond you bought yesterday to today, right? Let's say that yesterday the bond you bought yielded 10%. Okay, that means you were getting 10% a year in return. Okay, tomorrow that the interest rate drops to say 9%, right? So someone out in the market to buy a bond today, okay, he will only get 9% return, but you're getting 10%. So if you were to sell that bond, you would sort of mark up your bond to a price where it actually yields what the market is yielding today, which is 9%. That means if you paid $100 and you were paying getting 10% on that bond, you would mark it up to a point where the effective yield becomes 9%, right? That's what you will have to do because the interest rates went down, so your bond prices went up, right? Uh, but look at where interest rates are today, and this is like old data already, right? 2018 is old data. Today they're almost like, I think this is 10-year treasury bonds. They're almost touching 0.5%, okay? That means uh, look at where they were. They were like around say 14%. Okay, that means people today are willing to lend money to the U.S. government, okay, for 10 years time frame, and only get 0.5% a year. Okay, so that's what the situation is today. So of course, that's unlikely to be repeated again, and all is likely to happen. Either the rates are going to stay flat to down, flat, because there is not much room for them to go down below zero, right? They could actually go zero, but that's a completely different ball game. But they are unlikely to go too low anymore, lower than what we have now, right? That means the interest rates are either going to stay flat or go up. If they go up, your bond prices will go down. So the returns you basically were modeling based on this portfolio you created. So you need to sort of bring in some understanding of what is going on in the market today to sort of create a portfolio which you can sort of carry on for the next 25, 30, 40, 50 years for the rest of your life, right? Let's look at, and that same relationship exists with the stock market, right? And it has to, right? So let's say, and this is the value of a stock in a large company stocks, right? Why? So say you need say you need to make a capital investment to increase, say, production of whatever stuff you're in the business of making, right? And so you go to a bank for a loan, and let's say the loan duration is for 10 years, right? The prevailing interest rate at that time, just like that example we were giving, is say 10%, right? Now you make those interest payments on time for the first year, and record whatever profits your business is supposed to generate, which and when you calculate profit is of course after all the expenses, and one of the expenses is interest expense, right? But now say the rates decline to say 8% or 7% or whatever it is, right? What would you do as a business owner, right? You are basically supposed to extract as much profit as possible from your business. So the first thing you're going to do is go to the bank and refinance your loan, right? Saying that, hey, I'm not willing to pay 10%, you need to mark it down. If you don't mark it down, I'm going to take it to another bank, right? So the banks will sort of refinance your loan to the new 8%, okay? That means now you have this 2% delta which you are actually able to add straight to your bottom line, right? So basically the value of your business just went up because now you're generating more profits, right? And that's why I think some of that is reflected in that in the value of a stock portfolio as interest rates have gone down over time, right? And something very similar happens in real estate. Actually, real estate happens to that to an even bigger extent, because real estate is basically packaged commodities, right? So it just sits there. It doesn't reinvent the wheel. It doesn't come up with a cure for cancer or anything. It's just a place to shelter, to provide shelter, right? So it's a very interest rate sensitive asset, because a lot of the stuff people do in real estate business are basically doing it with borrowed money, right? So when you are borrowing money to create a home or to buy a home or to build a home, right, you are basically very, very sensitive to interest rates. And as your borrowing cost goes down, the value of your asset actually goes up, and that's what we have seen. Is it going to repeat again? Not likely, not a chance, right? So, so, uh, so what I'm trying to say here is that though we have run through all this math, sometimes you have to take this math with a grain of salt, right? So it's not complete slam dunk. You just cannot take past data and extrapolate it out in the future. You have to bring in your own theory, your own judgment, your own assessment, and that's what a good data scientist or a good data analytics person will sort of do, right? Because you need to sort of understand what you're doing with that data and how does it impact the current environment based on what has happened in the past and what is likely to happen in the future, right? So it's not all that we completely ignore theory. We use a bit of this and a bit of our understanding of history, business, and the economy to create a portfolio that is just right for you, right? And once that's done, we should be willing to persevere, okay? Because with this portfolio thing, with your money management thing, right? The most important thing is you, okay? And that's where people sort of get into trouble, that they cannot control their emotions in light of what is happening in the market, right? And enduring through all the ups and downs and associated with our choices in the coming decades, right? Because as Morgan Housel, so this is one of the writer I sort of he writes pretty good. You can look him up. So something stupid you can stick with will probably outperform something smart that you'll burn out on, right? And he was providing different examples of how people, the supposedly super smart people, burn out on stuff uh, because they are not willing to stick with it, right? So our ability to stick with what we own in our portfolios, okay, provided we have justifiable, to us for sure, right? Justifiable and quantifiable reasons to own what we own is what will ultimately count, right? So that's a little bit on mean variance optimization and your portfolio and running through all this math, and and I hope it was worth it, because we're going to talk a little bit more about this kind of stuff. And ultimately, what we're trying to do is we're trying to sort of use this different examples, different applications to sort of at least, if nothing you can take away from this, you can at least take away some of this stuff which can help you later on in life, right? So on to the next module.